out right now the exact time.
Will it be on Tuesday? It's been reported it'll be Tuesday.
I think so.
Do you have an update on how talks have gone this weekend, sir?
I have.
Can you share that with us?
No.
Okay.
What's your level of optimism about that?
That's sharing it, isn't it?
Well, it's giving us a clue.
Do you think you'll be able to leave for the G7?
That's my plan as it stands now.
Mr. President, are you open to tougher work requirements for certain government aid programs like Republicans are proposing as part of these discussions?
I voted for tougher aid programs. It's in the law now. But for Medicaid, it's a different story. Look,
Their position and where they're...
what I've learned a long time ago, and you know as well as I do, it's never as good to characterize a negotiation in the middle of a negotiation. I remain optimistic because I'm a congenital optimist. But I really think there's a desire on their part as well as ours to reach agreement. I think we'll be able to do it.
What is your opinion on the current state of the market and its pricing for the year end? Specifically, the January Fed funds contract stands at 440, 439, indicating a 75 basis point difference for the entire year. Do you find this worrisome, and if so, what factors do you believe contribute to the difference?
You know, I've been really wondering about this for a long time because, you know, in my world, inflation is not going to come down very quickly, and in that regard, then cutting rates doesn't really fit into that scenario. So, you know, the markets, I think, have been pretty optimistic about how easily inflation will respond to our policy. Honestly, I hope I'm wrong and they're right, because that'll mean that the economy is in balance sooner than later. But it's not my baseline case at all. I try not to speak for the markets. What I would say is, even in my building, there is a lot of debate about how strongly our policy is going to bite on the economy. Some think it's actually going to bite really, really strong and come down fairly rapidly, but our fairly rapidly is not even as rapid as the markets are. So my baseline case is we won't really be thinking about cutting till well into 2024. I think what we're going to see is just an orderly decline. I'm hoping that we see what we've seen over the last several months, where inflation has come from a very high level to now it's just a high level. But even if you look at most measures of inflation, they're still 2 times where our target is. And so there's a long distance still to go. If I had a bias between going up and going down as our next action, I would say we might have to go up. All right, what we've seen is that inflation has been persistently high. Consumers have been really resilient in terms of their spending, and labor markets remain extremely tight. All of those suggest that there's still going to be upward pressure on prices. Now, that's not my base case either. For about 6 months now in the dot plot, this is at the level I want us to get to, and now we can wait and see. But if there's going to be a bias to action, for me it would be a bias to increase a little further as opposed to cut. And I go around and talk to lots of folks. They all tell me the labor market is easier for them today than it was 12 months ago, which suggests that there is some easing that's happening in the labor market. Now, it's not happening super fast, and we still have a lot of dynamics in the pandemic that are affecting labor force participation in segments of the economy. But I do think there's been progress. There's definitely been progress on inflation, and you know, for me, I think we've done, if you think about this, the easiest part of inflation reduction. Right. Now it's going to take some time to work through the services. Goods are going to still stay somewhat volatile. You know, one thing I would say that's very encouraging to me, when you look at the CPI report that came out last week, less than 50% of the items in the basket now are showing 5% increase.
Do you share the concern that when inflation remains consistently high, around 4.5% to 5%, consumers and businesses may adapt to it, leading to a situation where businesses raise prices and consumers start demanding higher wages, thereby further raising concerns?
Of course. I mean, if inflation expectations really become unanchored from the levels that we want it to be, then everyone's behavior changes, and it can almost be a self-fulfilling prophecy. Now, fortunately, as we do our surveying of businesses and my conversations with bankers and just regular families, they all tell me that they understand that this is still a very short-run episode, and that they're not expecting the long-term reality to be at this level. There's still a lot of confidence that our policies are going to be able to get inflation back down to our 2% target. And to be fully clear, we're going to do all that we need to make sure that that happens.
Considering that we have already reached a level of 5% to 5.25%, and there might be additional tightening of 50, 75 or even 100 basis points from the financial sector, why doesn't that make you reconsider whether we have already reached the desired target? Why don't you think that further action may not be necessary if these factors are taken into account?
I'll say 2 things on this. So first, I don't really do that calculating like how much bank action translates into Fed funds rates. I think there are a lot of implicit assumptions there that makes that a really difficult exercise. But the second thing I would say is when we raised rates, my expectation was that financial conditions were going to tighten. The crisis did that on some level. Now, I would have hoped that it had tightened, that the financial conditions tightened in a somewhat more orderly fashion. But we're seeing the tightening that needed to happen, and now the question is, how much is that really going to bind on activity? In my baseline case, I think it will continue to slow down the economy, but it's not going to be in big chunks. I think this is going to be a gradual thing over an extended period of time, and that's why I think the appropriate policy is really just to wait and see how much the economy slows from the policy actions that we've done.
President Bostic expresses his view that cutting rates may not be suitable in the current scenario, as he believes inflation will not decline rapidly. He mentions that the market have been optimistic about how inflation responds to policy, but he hopes they are right and the economy balances sooner. He indicates that his baseline case does not involve considering rate cuts well into 2024. He acknowledges the market's pricing for the year end as indicated by the January Fed funds contract, noting the 75 basis point difference and raises a question of whether it is worrisome. However, he does not explicitly explain the reasons behind the disconnect between market pricing and his own outlook. He emphasized that inflation has been persistently high and factors such as resilient consumer spending and tight labor markets suggest upward pressure on prices. While he does not indicate that increasing rates is his base case, he mentioned that if there was a bias towards action, it would lead towards rate increases rather than cuts. Looking at the labor market, stating that while there has been progress, it is not happening rapidly due to the lingering effects of the pandemic. Also acknowledging progress in reducing inflation, but mentions that it will take time for it to work through the system, particularly in the services sector. He also sees the concern that if inflation remains at elevated levels for an extended period, it could lead to a change in behavior among consumers and businesses, resulting in a self-fulfilling prophecy. He highlights the importance of anchoring inflation expectations and expresses confidence that policies will bring inflation back down to the 2% target.
The real question is, where are we going to be a month from now? A month from now, after it's resolved, then where are 2-year rates? My guess is they may be a little higher. There's risk premiums in everything. Risk premiums in gold, risk premium in stocks, risk premium in rate structures, because we're all terrified of the debt ceiling. So if those are gone, stocks are probably a little higher, gold's probably a little lower, rates might be a touch higher, because those risk premiums will disappear. So that's the very shortest term. I think you'll have some kind of indigestion along the way, and yes, I'd buy that. Then we have, in a more intermediate basis, we have the financial cycle. The financial cycle, which is what we kind of look at internally, is the combination of the historical debt and asset valuation boom bust.
Right.
So if you think about post-COVID, we had this massive increase in debt, massive increase in equity valuation. It creates this boom in the financial cycle. That's happened in 1990. That happened in 2000. That happened in 2008. Our financial cycle, the peak of total debt growth plus stock market valuation, occurred in September of 2021. I think, again, if I just think about this year and I think about 06, 07, 08, it doesn't mean that the stock market cannot go higher as the economy decelerates. If you just think about if that was the last hike that we just had, the playbook's real simple. 6 months from now, stocks are 10% higher. 6 months from now, interest rates are generally 50 to 70 basis points lower. There's a halcyon period post last hike where asset prices do okay. Commodities barely recover. The dollar kind of does nothing. This banking crisis, it's troubling to me because we just killed 3 big banks. And when I say we, I think bad monetary policy combined with bad fiscal policy created a situation that never had to happen. We knew in the fourth quarter of 2020, it was so obvious we were going to have a vaccine, but we continued with quantitative easing for an entire year after that. And the whole time, We're telling everyone rates are going to stay low forever. Inflation is not an issue. We're trying to get inflation above 2%. The banks, anyone that was listening to our Fed at that point in time was probably doing exactly what these banks did, extending maturities, because they were being told that inflation didn't exist. When it finally did come, as transitory, and rates were going to be low forever. We did not have to have all that overstimulus. And then all of a sudden we found out inflation wasn't transitory. They had to course correct a over exaggeration of what they were doing in 2020 monetary policy.
Jones likens the debt ceiling issue to kabuki theatre that may cause short-term market volatility, suggesting that once the debt ceiling is resolved, risk premiums may disappear, leading to potential increases in stock prices and interest rates. Looking at the financial cycle, which combines historical debt and asset valuation booms and busts, he points out that historically a 2-year lag between peak debt growth and stock market valuation and a subsequent recession occurs. Based on this pattern, he suggests that there is a good chance of approaching or entering a recession in the third quarter of the current year. Despite the possibility of a recession, Jones suggests the stock market can still perform well as the economy decelerates, presenting a scenario where 6 months from now stocks could be 10% higher and interest rates could be 50 to 70 basis points lower. Jones expresses concern about the banking crisis, attributing it to bad monetary policy combined with bad fiscal policy, suggesting that the Fed Reserve continued quantitative easing and low interest rate promises even when inflation was expected contribute to the crisis, highlighting the need for course correction and re-evaluation of monetary policy actions.